A government shutdown looms with the deadline now less than a week away. President Biden and Transportation Secretary Pete Buttigieg ramping up calls for Republicans to come to a resolution ahead of Sunday, warning of impacts to military paychecks, airlines, and public programs. But how is this going to impact stocks? Now, this would be the first shutdown since 2019, where the S&P 500 gained 13% during that 35-day stalemate. For more on this, we want to bring in Kevin Gordon, Charles Schwab, a senior investment strategist. Kevin, it's good to see you. So should we be using history as a guide if, in fact, we do see the government shut down, if they're not able to reach a deal by the end of the week? Are markets just going to shake that off?
I think you have to keep in mind sort of the context that we've been in, which is, a pretty weakening breadth profile under the surface for the market. So I think, as an investor, if you're looking at this purely from a market perspective and through that lens, you never want to use the shutdown as something that is going to drive the market in one direction or another. And, you're just talking about the most recent one. If you look at that episode, late 2018 into early 2019, that was a moment when we were coming off that near bear market low in December 2018. You had some pretty strong momentum carrying you through into 2019. So it was pretty hard to work against that current. And then almost conversely, if you go back to the shutdowns that we had in the 70s, we were mired in a secular bear market for stocks, but also fighting a stagflation issue. So I think the backdrop from an economic and a market perspective matters a lot more than, sort of the short-term driver of what the potential shutdown means for the economy from a pothole perspective, not necessarily an entire economic slowdown perspective.
All that considered, though, Kevin, when you think about some of the areas of government that would be shut down, are there potential trades, portfolio positions that investors should consider in this type of environment, and knowing that there could be still much negotiation that needs to come forward even after a potential shutdown?
Well, I think the good news in this environment, and Brad, you and I have talked about this before, where you never want to be looking at, especially from a sector perspective, you don't want to be thinking, monolithically or traditionally in terms of what works defensively in an environment when things are slowing down or you're getting a weaker profile from the market. And, case in point is since the peak at the end of July, at least for the S&P 500, the only outperformer and the defensive area of the market has been energy. And yeah, that's, I think, synonymous with what's going on with oil, but also the fact that energy scores pretty well from an interest coverage ratio perspective, meaning, a lot of those companies have the money and have the funds available to pay off interest expense. That's not the case for the rest of the market. Certainly not the case for some of the consumer staples areas, which you would typically consider defensive. So even under the defensive or traditional defensive sector umbrella, utilities look very different from staples. They're trading in different ways. Utilities doing a little bit better, now outperforming energy, but doing a little bit better than what would traditionally be considered safe from a staples perspective.
So, Kevin, taking all that into account, then I guess when investors are trying to figure out when they should be more comfortable adding some of that risk back into their portfolio, what are some of the signs or some of the things that they need to be watching for?
Well, I think improving breadth under the surface, because you're now at a point where a lot of what had started to look better from our perspective, June into July, somewhat into August, where participation was broadening out. You had seen it a little bit down the cap spectrum. You had seen it kind of equal weight versus, cap weight S&P, but that started to unwind from August into September. And now, the unfortunate part is whether you're looking at the percent of stocks above their 50-day moving average or above their 200-day moving average within the S&P, the NASDAQ, or the Russell, all of those breadth statistics have started to break down. So it hasn't been the case, which is what we were looking for, where some of the air is coming out of the mega cap names, the leaders and the high flyers that were driving the market's gains this year. It hasn't been the case where that air is going back into the rest of the market. It's kind of been this broader scale breakdown from a breadth point of view. So I think that if you get a stabilization there and you start to see the rest of the market do a little bit of heavy lifting, you get that lift from earnings and forward earnings expectations. And I would add, you get a lift from revenue expectations, because that's kind of what was missing in the most recent earnings season. That, those are sort of the ingredients that you need, I think, to kind of move out on the risk spectrum a little bit. But I think for now, given the unique nature of this cycle, given the kind of non-confirmations along the way, almost a year after a major market low, you're not seeing signs you would typically see in a strong or a durable bull market. You really just want to stay defensive in factor or characteristic terms, not necessarily like I was saying from a sector perspective, but moving up in quality, staying high in that quality, area, whether it's large cap versus small cap, whether it's high interest coverage versus low interest coverage, things of that nature.
Kevin, even as I'm looking at the futures this morning here, and we're seeing some fractional declines across the U.S. major averages, it comes off of last week where some chop was reinitiated, and that really driven by the Fed's commentary and the markets really digesting what a more hawkish Fed might continue to mean in terms of their own rate policy going forward from here. What type of overhang do you believe that that's going to be in Q4 as we kind of are basically in the last week and closing the books on Q3 now?
Well, I think even beyond Q4, what you have to now keep in mind, and most recently Austin Goolsbee was out this morning talking about this, is it's not the higher for longer, the higher part of that. It's now the for longer. And Jay Powell was kind of alluding to this, where we now need to start considering whether they hike again or not in November. I'm not sure that's as much the focus as it is moving into next year and how long they stay at a restrictive level. Whether the rate cuts that the market's pricing in right now are correct in the sense that they're just going to be a little incremental and the Fed still keeps real rates elevated, or if we do have to turn around, or if the Fed does have to turn around, start to pivot aggressively and cut rates, but that would be, kind of for the wrong reasons economically. But I think, the overarching theme of all of this is, as you mentioned, you have to start thinking about what are the knock-on effects from what they've already done, and then what do we start to see as they keep rates restrictive? Because you're just getting to that restrictive level now, as the Fed believes, and you still need to see key parts of inflation that they're tracking roll over. You could look at just core goods versus core services inflation, and most of the disinflation progress so far has been in the former, and that's the supply chain unwind. That's kind of the pandemic unwind from all the stress that we had in the bottleneck. So as that's kind of been alleviated, now you have to shift your attention to services and then any connection that has with the labor market. So, any tightness you see in labor, any, potential unwind there, yeah, that probably alleviates some of the inflation pressure, but is the expense, sort of on the economic side where you start to see spending slow down, and then that tips you into more of a slowdown or a recessionary environment. Too soon to tell what that's going to look like. But I think you have to keep that dynamic in mind, especially now that we're getting closer to the end of the tightening cycle than we are at the beginning.
Yeah, and Kevin, given that, I'm curious, what's your base case just in terms of what we're going to see from Fed policy and then the odds or the possibility of a recession? Are you still confident that we are going to be able to avoid a recession and go back to more that soft landing scenario?
Well, one of our thesis has been for the past year and a half that the economy's been suffering from some form of recession. It's just been rolling in nature, where it started on the goods and the manufacturing side. In housing in particular last year, housing definitely went through its own recession. Some parts of the housing market are still in recession, but some of those indicators have started to turn up a little bit, whether it's home builder sentiment, although we've had a little bit of a rollover in the past couple of months. But you haven't had any recessionary-like readings within the services part of the economy or within the labor market. So you've had that nice offset of strength in services and labor, where you've had significant weakness and deterioration within manufacturing and goods. So if you can continue to see the roll through of the recession, where you start to get some rolling recoveries in manufacturing and in goods, but then you start to see a little bit of a slowdown in services and labor, that in our mind, that's best case scenario. But if you do start to see some of these rolling recoveries stunted a bit, and then you also get you don't have an offset anymore from services or labor, then that probably puts the economy into what is more, considered more of a traditional recession. So again, probably the most unique cycle we've ever seen. That makes it kind of tougher to call. But the biggest piece to all of this is labor, because if you slow that down enough, you sort of cut the spending power that consumers have had now that you have this kind of savings cushion that has, wound down pretty much not to nothing, but, getting closer to that point. That's probably the most important dynamic to consider right now, especially as it pertains to Fed policy, too.
Kevin Gordon, Charles Schwab, Senior Investment Strategist. Kevin, always a pleasure to get your insights here. Thanks for kicking off the week with us.